Hello guys, and welcome back to Leah's Lifestyle. We're out again with the second half of the 1984 Berkshire Hatchway letters to shareholders, and we're going to start this one out at errors in loss reserving. Any shareholder in a company with important interest in the property/casualty insurance business should have some understanding of the weakness inherent in the reporting of current earnings in that industry. Phil Graham, when publisher of the Washington Post, described the daily newspaper as a first rough draft of history. Unfortunately, the financial statement of a property casualty insurance provide, at best, only a first rough draft of earnings and financial conditions. Indetermination of cost is the main problem. Most of an insurer's costs result from losses on claims, and many of the losses that should be charged against the current year revenue are exceptionally difficult to estimate. Sometimes the extent of these losses or even their existence is not known for decades. The loss expense charged in a property/casualty company's current income statement represents 1. Losses that occurred and were paid during the year. 2. Estimates for losses that occurred and were reported to the insured during the year, but which have yet to be settled. 3. Estimates of ultimate dollar cost for losses that occurred during the year, but of which the insurer is unaware, termed IBNR, incurred but not reported. And 4. The net effect of revision this year of similar estimates for 2 and 3 made in past years. Such revisions may be long delayed, but eventually any estimate of losses that causes the income for year X to be misstated must be corrected, whether it is in the year X plus 1 or X plus 10. Thus, performance means that earnings in the year of correction also are misstated. For example, assume a climate was injured by one of a climate. What a climate? Climate. I feel like I'm saying this word wrong. I feel like it should be client, but there's an M. So I'm saying climate. Like, is it supposed to be client? Assume a client was earned. I think it's client. I feel like it's mistyped. Is that how you spell client? Weird. Was insured by one of our insureds in 1979, and he went through a settlement was likely to be made for $10,000. That year we would have charged $10,000 to our earnings statement for the estimate cost of the losses, and correspondingly set up a liability reserve on the balance sheet for that amount. If we settled the claim in 1984 for $100,000, we would charge earnings with a loss cost of $90,000 in 1984. Although the cost was truly an expense of 1979, and if that piece of business was our only activity in 1979, we would have badly misled ourselves as to costs and you as to earnings. The necessarily extensive use of estimates in assembling the figures that appear in such deceptively precise form in the income statement of property/casualty companies means that some error must seep in. No matter how proper the intentions of management, in an attempt to minimize error, most insurers use various statistical techniques to adjust the thousands of individual loss evaluations, called case reserves, that compromise the raw data for estimation of aggregate liabilities. The extra reserves created by these adjustments are variously labeled bulk, development, or supplemental reserves. The goal of the adjustment should be a loss reserve total that has a 50-50 chance of being proved either slightly too high or slightly too low when all losses that occurred prior to the data of the financial statement are ultimately paid. At Berkshire, we have had what we thought were appropriate supplemental reserves, but in recent years, they have not been adequate. It is more important that you understand the magnitude of the errors that have been involved in our reserving. You can thus see for yourselves just how imprecise the process is, and also judge whether we may have some systematic basis that should make you wary of our current and future figures. The following table shows the results from these insurance underwritings as we have reported them to you in recent years, and also give you calculations a year later if we knew then what we think we know now basis. I said what we think we know now because the adjustment figures still include a great many estimates for losses that occurred in the earlier years. However, many claims from the earlier years have been settled so that our 1 year later estimate contains less guesswork than our earlier estimate. So it says underwriting results as reported to you and corrected figures after 1 year experience. 1980, 6,738,000, 14,887,000. In 81, 1,470,000, and then I think this is negative 1,180,000. In 82, negative 21,462,000, negative 25,066,000. In 83, negative 33,192,000. Negative 50,974,000. In 84, negative 45,413,000, and then a question mark for year after because it hasn't been a year after during this time. Our structured settlement and loss reserve assumption businesses are not included in this table. Important additional information on loss reserve experience appears on page 43 to 45. To help you understand this table, here's an example of the most recent figures. 1984's reported pre-tax underwriting loss of $45.5 million, consistent of $27.6 million we estimated that we lost on 1984's businesses, plus the increased loss of $17.8 million reflected in the corrected figure for 1983. As you can see from reviewing the table, my error in reporting to you have been substantial and recently have always presented a better underwriting picture than was truly the case. This is a source of particular charging to me because 1, I like for you to be able to count on what I say. 2, our insurance managers and undoubtedly acted with less urgency than we would have had we understood the full extent of our losses. And 3, we paid income taxes calculated on overstated earnings and thereby gave the government money that we didn't need to. These overpayments eventually correct themselves, but the delay is long and we don't receive interest on the amount we overpaid. Because our business is weighted towards casualty and reinsurance lines, we have more problems in estimating loss costs than companies that specialize in property insurance. When a building that you have insured burns down, you get a much faster fix on your costs than you do when an employer you have insured finds out that one of his retirees has contracted a disease attributable to work he did decades earlier. But I still find our errors embarrassing. In our direct business, we have far underestimated the mushrooming tendency of juries and courts to make the deep pocket pay. Regardless of the factional situation and the past procedures for establishment of liability, we also have underestimated the contagious effect that publicity regarding giant awards has on juries. In the reinsurance area, where we have had our worst experience in under-reservings, our customer insurance companies have made the same mistake. Since we set reserves based on information they supplied us, their mistakes have become our mistakes. I heard a story recently that is applicable to our insurance accounting problems. A man was traveling abroad when he received a call from his sister informing him that their father had died unexpectedly. It was physically impossible for the brother to get back home for the funeral, but he told his sister to take care of the funeral arrangements and to send the bill to him. After returning home, he received a bill for several $1,000s, which he promptly paid. The following month, another bill came along for $15, and he paid that too. Another month followed with a smaller bill. When in the next month a third bill for $15 was presented, he called his sister to ask what was going on. "Oh," she said, "I forgot to tell you. We buried Dad in a rented suit." If you've been in the insurance business in recent years, particularly the reinsurance business, this story hurts. We have tried to include all of our rental suits liabilities in our current financial statement, but our record of past error should make us humble and you suspicious. I will continue to report to you the errors, plus or minus, that surface each year. Not all reserving errors in the industry have been of the innocent but dumb variety, with underwriting results as bad as they have been in recent years, and with managements having as much discretion as they do in the presentation of financial statements. Some unattractive aspects of human nature have manifested themselves. Companies that would be out of business if they realistically appraised their lost costs have, in some cases, simply preferred to take an extraordinarily optimistic view about these yet-to-be paid sums. Others have engaged in various transactions to hide true current loss costs. Both of these approaches can work for a considerable time. External auditors cannot efficiently police the financial statement of property/casualty insurers if liabilities of an insurer correctly stated would exceed assets. It falls to the insurer to volunteer this morbid information. In other words, the corpse is supposed to file the death certificate under this honor system of mortality. The corpse sometimes gives itself the benefit of the doubt. In most businesses, of course, insolvent companies run out of cash. Insurance is different. You can be broke but flush. Since cash comes in at the inception of an insurance policy and losses are paid much later, insolvent insurers don't run out of cash until long after they have run out of net worth. In fact, these Walking Dead often redouble their efforts to right businesses, accepting almost any price or risk, simply to keep the cash flowing in. With an attitude like that of an embezzler who has gambled away his purloined funds, these companies hope that somehow they can get lucky on the next batch of business and thereby cover up early shortfalls. Even if they don't get lucky, the penalty to managers is usually no greater for 100 million shortfall than one of 10 million. In the meantime, while the losses amount, the managers keep their jobs and perquisites. The loss reserving errors of these property/casualty companies are of more than academic interest in Berkshire. Not only does Berkshire suffer from sell at any price competition by the Walking Dead, but we also suffer from their insolvence is finally acknowledged. Through various states' guaranteed funds that levy assessments, Berkshire ends up paying a portion of the insolvent insurer's assets of deficiencies, swallowed as they usually are by the delayed deduction that results from wrong reporting. There is even some potential for cascading trouble. The insolvence of a few large insurances and assessments by state guarantee funds that would follow could imperil weak but previously solvent insurers. Such dangers can be mitigated if state regulators become better at prompt identification and termination of insolvent insurers. But progress on that front has been slow. Washington Public Power Supply System. From October 1983 through June 1984, Berkshire's insurance subsidiaries continuously purchased large quantities of bonds of projects 1, 2, and 3 of Washington Public Power Supply Systems, WPPSS. This is the same entity that on July 1st, 1983, defaulted on $2.2 billion of bonds issued on finance partial construction of the now abundant projects 4 and 5. While there are material differences in the obligors, promises, and properties underlining the two categories of bonds, the problem of projects 4 and 5 have cast a major cloud over projects 1, 2, and 3, and might possibly cause serious problems for the later issue. In addition, there have been multiple problems related directly to projects 1, 2, and 3 that could weaken or destroy an otherwise strong credit position arising from guarantees by Bonneville Power Administration. Despite these important negatives, Charlie and I judged the risk at the time we purchased the bonds and the price Berkshire paid much lower than the present prices, to be considerably more than compensated for by prospects of profit. As you know, we buy marketable stocks for our insurance companies based upon the criteria we would apply in purchase of an entire business. This business valuation approach is not widespread among professionals, money managers, and is scorned by many academics. Nevertheless, it has served its followers well, to which the academics seem to say, well, it might be all right in practice, but it will never work in theory. Simply put, we feel that if we can buy small pieces of businesses with satisfactory underlying economics at a fraction of the per share values of the entire business, something good is likely to happen to us, particularly if we own a group of such securities. We extended this business valuation approach even to bond purchases such as WPPSS. We compare the $139 million costs of our year-end investment in WPPSS to a similar $139 million investment in an operating business. In the case of WPPSS, the business contractually earns $22.7 million after tax via the interest paid on the bond, and those earnings are available to us currently in cash. We are unable to buy operating businesses with economic close to these. Only a relatively few businesses earn the 16.3% after tax on unlevered capital that our WPPSS investment does, and those businesses, when available for purchase, sell at large premiums to the capital. In the average negotiation business transaction, unlevered corporation earnings of $22.7 million after tax, equivalent to about $45 million pre-tax, might command a price of $250 to $300 million, or something far more. For a business we understand well and strongly like, we will gladly pay that much, but it is double the price we paid to realize the same earnings from WPPSS bonds. However, in the case of WPPSS, there is what we view to be a very slight risk that the business could be worth nothing within a year or two. There also is the risk that interest payments might be interpreted for a considerable period of time. Furthermore, the most that the business could be worth is about the $205 million face value of the bonds that we own, an amount only 48% higher than the price we paid. This ceiling upon potential is an important minus. It should be realized, however, that the great majority of operating businesses have a limited upside potential, also unless more capital is continuously invested in them. That is so because most businesses are unable to significantly improve their average return on equity even under inflationary conditions, though these were once thought to automatically raise returns. Let's push our bond as a business example one notch further. If you elect to retain the annual earnings of a 12% bond by using the proceeds from coupons to buy more bonds, earnings of that bond business will grow at a rate comparable to that of most operating businesses that similarly reinvest all earnings. In the first instinct, a 30-year zero coupon 12% bond purchased today for $10 million will be worth $300 million in 2015. In the second, a $10 million business that regularly earns 12% on equity and retains all earnings to grow will also end up with the same $300 million of capital in 2015. Both these businesses and the bonds will earn over $32 million in the financial year. Our approach to bond investment, treating it as an unusual sort of business with special advantages and disadvantages, may strike you as a bit quirky. However, we believe that many staggering errors by investors could have been avoided if they had viewed bond investments with a businessman's perspective. For example, in 1946, 20-year AAA tax-exempt bonds traded at slightly below 1% yield. In effect, the buyer of those bonds at the time bought a business that earned about 1% on book value, and that, moreover, could never earn a dime more than 1% on book, and paid 100 cents on the dollar for the abominable business. If an investor had been businessman-minded enough to think in those terms, and that was the precise reality of the bargain struck, he would have laughed at the position and walked away. For at the same time, business with excellent future prospects could have been bought at or close to book value while earning 10, 12, or 15% after tax on books. Probably no business in America changed hands in 1946 at book value that the buyer believed lacked the ability to earn more than 1% on book. But investors with bond buying habits eagerly made economic commitments throughout the year on that basis. Similar, although less extreme, conditions prevailed for the next 2 decades as bond investors happily signed up for 20 or 30 years on terms outrageously inadequate to business standards. And that, I think, is by far the best book of investing ever written, The Intelligent Investor by Ben Graham. The last section of the last chapter begins with, investment is most intelligent when it is the most businesslike. This section is also a final word, and it is appropriately titled. We will emphasize again that there is unquestionably some risk in the WPPSS commitment. It is also the sort of risk that is difficult to evaluate. Were Charlie and I to deal with 50 similar evaluations over a lifetime, we would expect our judgment to prove reasonably satisfactory. But we do not get the chance to make 50 or even 5 such decisions in a single year. Even though our long-term results may turn out fine, in any given year we run a risk that we will look extraordinarily foolish. That's why all of these statements say Charlie and I, or we. Most managers have very little incentive to make the intelligent, but with some chance of looking like an idiot, decision. Their personal gain/loss ratio is all too obvious. If an unconventional decision works out well, they get a pat on the back, and if it works out poorly, they get a pink slip. Failing conventionally is the route to go. As a group, lemmings may have a rotten image, but no individual lemming has ever received bad press. Our equation is different. With 47% of Berkshire stock, Charlie and I don't worry about being fired, and we receive our rewards as owners, not managers. Thus, we believe with Berkshire's money, as we would with our own, that frequently leads us to unconventional behavior both in investment and general business management. We regain unconventional in the degree to which we concentrate the investment of our insurance companies, including those in WPPSS bonds. This concentration makes sense only because our insurance business is conducted from a position of exceptional financial strength. For almost all other insurers, a comparable degree of concentration, or anything close to it, would be totally inappropriate. Their capital positions are not strong enough to withstand a big error, no matter how attractive an investment opportunity might appear when analyzed on the business of profitabilities. With our financial strength, we can own large blocks of a few securities that we have thought hard about and bought at attractive prices. Billy Rose described the problem of of over diversification. If you have a harem of 40 women, you never get to know any of them very well. Over time, our policy of concentration should produce superior results, though these will be tempered by our large size. When this policy produces a really bad year, as it must, at least you will know that our money was committed to the same basis as yours. We made the major part of our WPPS investment at different prices and under somewhat different factual circumstances than exist at present. If we decide to change our position, we will not inform shareholders until long after the change has been completed. We may be buying or selling as you read this. The buying and selling of securities is a competitive business, and even a modest amount of added competition on either side can cost us a great deal of money. Our WPPSS purchase illustrates this principle. From October 1983 through June 1984, we attempted to buy almost all the bonds that we could of projects 1, 2, and 3. Yet we purchased less than 3% of the bonds outstanding, and we faced even a few additional well-heeled investors stimulated to buy because they knew we were. We could have ended up with a materially similar amount of bonds purchased at a materially higher price. A couple of coattail riders easily could have cost us $5 million. For this reason, we will not comment about our activities in securities neither to the press, nor shareholders, nor to anyone else, unless legally required to do so. One final observation regarding our WPPSS purchases. We dislike the purchase of most long-term bonds under most circumstances and have bought very few in recent years. That's because bonds are as sound as a dollar, and we view the long-term outlook for dollars as dismissal. We believe substantial inflation lies ahead, although we have no idea what the average rate will turn out to be. Furthermore, we think that there is a small but not insignificant chance of runaway inflation. Such a possibility may seem absurd, considering the rate of which inflation has dropped, but we believe that present financial policies, featuring a huge defect, is both extremely dangerous and difficult to reverse. So far, most politicians in both parties have followed Charlie Brown's advice. No problem is so big that it can't be run away from. Without a reversal, high rates of inflation may be delayed, perhaps for a long time, but will not be avoided. If high rates materialize, they bring with them the potential for a runaway upward spiral. While there is not much to choose between bonds and stocks as a class, when annual inflation is in the 5 to 10% range, runaway inflation is a different story. In this circumstance, a diversified stock portfolio would almost surely suffer an enormous loss in real value, but bonds already outstanding would suffer far more. Thus, we think an all bond portfolio carries a small but unacceptable wipeout risk, and we require any purchases of long-term bonds to be clear a special hurdle. Only when bonds purchase appear decidedly superior to other business opportunities will we engage in them. Those occasions are likely to be few and far between. Dividend policies. Dividend policy is often reported as shareholders, but seldom explained. A company will say something like, our goal is to pay out 40 to 50% of earnings and to increase dividends at a rate at less equal to the rise in the CPI. Oh, excuse me. Our goal is to pay out 40 to 50% of earnings and to increase dividends at the rate at least equal to the rise in the CPI. And that's it. No analysis will be supplied as to why that particular policy is best for the owner of the business. Yet, allocation of capital is crucial to business and investment management. Because it is, we believe managers and owners should think hard about the circumstance under which earnings should be retained and under which they should be distributed. The first point to understand is that all earnings are not created equal, and any business particularly those that have high asset portfolio ratios, inflation causes some or all of the reported earnings to become ERATs. The ERATs portion, let's call these earnings restricted, cannot, if the business is to retain its economic position, be distributed as dividends. Were these earnings to be paid out, the business would lose ground in one or more of the following areas: its ability to maintain its unit volume of sales, its long-term competitive position, its financial strength. No matter how conservative its payout ratio, a company that constantly distributes restricted earnings is destined for oblivion unless equal capital is otherwise infused. Restricted earnings are seldom valueless to owners, but they often must be discounted heavily. In effect, they are conscripted by the business, no matter how poor its economic potential. This retention, no matter how unattractive the return situation was, communicated unwittingly in a miraculously ironic way to consolidate Edison a decade ago. At the time, a punitive regulatory policy was a major factor causing the company's stock to sell as low as 1/4 of book value, i.e., every time a dollar of earning was retained for reinvestment in the business, that dollar was transformed into only 25 cents of market value. But despite this gold into lead process, most earnings were reinvested in the business rather than paid to owners. Meanwhile, at construction and maintenance sites throughout New York, signs proudly proclaimed the corporation slogan, "Dig we must." Restricted earnings need not concern us further in this dividend discussion. Let's turn to the much more valued unrestricted variety. These earnings may, with equal feasibility, be retained or distributed. In our opinion, management should choose whichever course makes greater sense for the owners of the business. This principle is not universally accepted. For a number of reasons, managers like to withhold unrestricted, readily distributable earnings from shareholders to expand the corporate empire over which the manager rules, to operate from a position of exceptional financial comfort, etc. But we believe there is only one valid reason for retention. Unrestricted earnings should be retained only when there is a reasonable prospect, backed preferably by historical evidence or, when appropriate, by a thoughtful analysis of the future, that for every dollar retained by the corporation, at least $1 of market value will be created for owners. This will happen only if the capital retained produces incremental earnings equal to or above those generally available to investors. To illustrate, let's assume that an investor owns a risk for free 10% perpetual bond with one very unusual feature. Each year, the investor can elect either to take his 10% coupon in cash or to reinvest that coupon in more 10% bonds with identical terms, i.e., a perpetual life and coupons offering the same cash or reinvestment option. If, in any given year, the prevailing interest rate on long-term risk-free bonds is 5%, it would be foolish for the investor to take his coupon in cash, since the 10% bond he could instead choose would be worth considerably more than 100 cents on the dollar. Under these circumstances, the investor wanting to get his hand on cash should take his coupon in additional bond and then immediately sell them. By doing that, he would realize more cash than if he had taken his coupon directly in cash. Assuming all bonds were held by rational investors, no one would opt for cash in an era of 5% interest rates, not even those bondholders needing cash for living purposes. If, however, interest rates were 15%, no rational investor would want his money invested for him at 10%. Instead, the investor would choose to take the coupon in cash, even if his personal cash needs were nil. The opposite course, reinvest of the coupon, would give an investor additional bonds with market value far less than the cash he could have elected. If he should want 10% bonds, he can simply take the cash received and buy them in the market where they will be available at a larger discount. An analysis similar to that made by our hypothetical bondholder is appropriate for owners in thinking about whether a company's unrestricted earnings should be retained or paid out. Of course, the analysis is much more difficult and subject to error because the rate earned on reinvestment earnings is not a contractual figure, as in our bond case, but rather a fluctuating figure. Owners must guess as to what the rate will average over the intermediate future. However, once an informed guess is made, the rest of the analysis is simple. You should wish your earnings to be reinvested if they can be expected to earn high returns, and you should wish them paid to you in low returns are the likely outcome of reinvestment. Many corporate managers reasons very much along these lines in determining whether subsidiaries should be distributed earnings to their parent company. At that level, the managers have no trouble thinking like intelligent owners, but payout decisions at the parent company level often are a different story. Here, managers frequently have trouble putting themselves in the shoes of their shareholders' owners. With this schizoid approach, the CEO of a multiple divisional company will intrinsic subsidiary A, whose earnings on incremental capital may be exceptional to average 5%, to distribute all available earnings in order that they may be invested in subsidiary B, whose earnings on incremental capital are expected to be 15%. The CEO's business school oath will allow no lesser behavior, but if his own long-term record with incremental capital is 5% and market rates are 10%, he is likely to impose a dividend policy on shareholders of the parent company that merely follows some historical or industry-wide payout pattern. Furthermore, he will expect managers of subsidiaries to give him a full account as to why it makes sense for earnings to be retained in their operations rather than distributed to the parent owner, but seldom will supply his owners with a similar analysis pertaining to the whole company. In judging whether managers should retain earnings, shareholders should not simply compare total incremental earnings in recent years to total incremental capital, because that relationship may be distorted by what is going on in a core business. During an inflationary period, companies with a core business characterized by extraordinary economics can use small amounts of incremental capital in the business at very high rates of return. As we discussed in last year's section on goodwill, but unless they are experiencing tremendous unit growth, outstanding businesses by defined general large amounts of excess cash, if a company sinks most of this money in other businesses that earn low returns, the company overall returns on rented capital may nevertheless appear excellent because of these extraordinary returns being earned by the portion of earnings incrementally invested in the core business. The situation is analogous to a pro-am golf event. Even if all of the amateurs are hopeless doofers, the team's best ball score will be respectable because of the dominating skills of the professionals. Many corporations that constantly show good returns both on equity and on overall incremental capital have, indeed, employed a large portion of their retained earnings on an economically unattractive, even disastrous basis. Their marvelous core business, however, whose earnings grow year after year, camouflage repeated failures in capital allocations elsewhere, usually involving high-priced acquisitions of businesses that have inherently mediocre economics. The managers at fault periodically report on the lesson they have learned from the latest disappointment. They then usually seek out further lessons. Failures seem to go to their head. In such cases, shareholders would be far better off if earnings were retained only to expand the higher returned business with the balance paid in dividends, or used to purchase stock, an account that increases the owner's interest in the exceptional business while sparing them particular participation in subpar businesses. Managers of high return businesses who consistently employ much of the cash thrown off by those businesses and other ventures with low returns should be held to account for those allocation decisions, regardless of how profitable the overall enterprise is. Nothing in this decision is intended to argue for dividends that bounce around from quarter to quarter with each wiggle in earnings or investment opportunities. Shareholders of public corporations understandably prefer that dividends be consistent and predictable. Payments, therefore, should reflect long-term expectations for both earnings and returns on incremental capital. Since the long-term corporation outlook changes only infrequently, dividend patterns should change no more often. But over time, distributable earnings that have been withheld by managers should earn their keep. If earnings have been unwisely retained, it is likely that managers, too, have been unwisely retained. Let's now turn to Berkshire Hathaway and examine how these dividend principles apply to it. Historically, Berkshire has earned well over market rates on retained earnings, thereby creating over $1 market value for every dollar retained. Under such circumstances, any distribution would have been contrary to the financial interest of the shareholder, large or small. In fact, significant distribution in the early years might have been disastrous, as a review of our starting position will show you. Charlie and I then controlled and managed 3 companies: Berkshire Hathaway Inc., Diversified Retailing Company Inc., and Blue Chip Stamps, all now merged into our present operation. Blue Chip paid only a small dividend. Berkshire and DRC paid nothing. If instead the companies had paid out their entire earnings, we almost certainly would have no earnings at all now, and perhaps no capital as well. The 3 companies which originally made their money from a single business, 1 textiles at Berkshire, 2 department stores at Diversified, and 3 trading stamps at Blue Chip, these cornerstone businesses, carefully chosen, it should be noted, by your chairman and vice chairman, have respectively 1. Survived but earned almost nothing, 2. Shriveled in size while incurring large losses, and 3. Shrunk in sale volume to about 5% its size at the time of our entry. Who says you can't lose them all? Only by committing available funds to much better businesses were we able to overcome these origins. It's been like overcoming a misspent youth. Clearly, diversification has served us well. We expect to continue to diversify while also supporting the growth of current operations, though, as we've pointed out, our return from these efforts will surely be below historical returns. But as long as prospective returns are above the rate required to produce $1 of market value per dollar retained, we will continue to retain all earnings. Should our estimate of future returns fall below that point, we will distribute all unrestricted earnings that we believe cannot be effectively used. In making that judgment, we will look at both our historical record and our perspectives. Because our year-to-year results are inherently volatile, we believe a 5-year rolling average to be appropriate for judging the historical record. Our president plans to use our retained earnings to further build the capital of our insurance companies. Most of our competitors are in weakened financial conditions and reluctant to expand substantially. Yet large premium volumes gains for the industry are imminent, amounting probably to well over $15 billion in 1985 versus less than $5 billion in 1983. These circumstances could produce major amounts of profitability business for us. Of course, this result is no sure thing, but perspectives for it are far better than they have been for many years. Miscellaneous. This is the spot where each year I run my small business wanted ad. In 1984, John Looms, one of the particularly knowledgeable and alert shareholders, came up with a company that met all of our tests. We immediately pursued this idea, and only a chance complication prevented a deal. Since our ad is pulling, we will repeat it in precisely last year's form. We prefer 1. Large purchases at least $5 million at after-tax earnings. 2. Demonstrated consistent earning power. Future projections are of little interest to us, nor are turnaround situations. 3. Business earnings, good returns on equity while employing little or no debt. 4. Management in place, we can't simplify it. 5. Simple businesses, we can't supply it. 5. A simple business. If there's a lot of technology, we won't understand it. 6. An offering price. We don't want to waste our time or that of the seller by talking, even primarily, about a transaction when price is unknown. We will not engage in unfriendly takeovers, and we went through that last time. A record of 97.2% of all eligible share participants in Berkshire's 1984 shareholder designated contribution program. So this is a contribution program that they are talking about. We urge new shareholders to read the description of our shareholder design. Our annual meeting will be on May 21st, 1985 in Omaha, and I hope that you attend. Many annual meetings are a waste of time, both for shareholders and for management. Actually, this year's in 2016 just passed recently. Sometimes that is true because management is reluctant to open up on matters of business substance. More often, a non-productive season is the full of shareholder participants who are more concerned about their own moment on stage than they are about the affairs of the corporation. What should be a form of business discussion becomes a form of theoretical venting and advocacy of issues. The deal is irresponsible. For the price of one share, you get to tell a captive audience your idea as to how the world should be run. Under such circumstances, the quality of the meeting often deteriorates from year to year as the antics of those interested in themselves discourage attendance by those interested in the business. Berkshire meetings are a different story. The number of shareholders attending grows a bit each year, and we have yet to experience a silly question or an ego-inspired commentary. Instead, we get a wide variety of thoughtful questions about the business. Because the annual meeting is the time and place for these, Charlie and I are happy to answer them all, no matter how long it takes. We cannot, however, respond to written or phoned questions at other times of the year. One person at a time reporting is a poor use of management time in a company with 3,000 shareholders. The only business matters that are off limits at the annual meeting are those about which candor might cost our company real money. Our activity in securities would be the main example. We always have bragged a bit on these pages about the quality of our shareholders' partners, some to the annual meetings, and you will see why. Out of our toners should schedule a stop at Nebraska Furniture Mart. If you make some purchase, you'll save far more than enough to pay for your trip, and you'll enjoy the experience. February 25th, 1985, Warren Buffett, chairman of board. And then there's a subsequent event. On March 18th, a week after a copy of this report went to the typographer, but shortly before production, we agreed to purchase 3 million shares of Capital Cities Communications Inc. at $172.50 per share. Our purchase is contingent upon the acquisition of American Broadcasting Company, Inc. by Capital Cities, and will close when that transaction closes. At the earliest, that will be very late in 1985. Our admiration for the management of Capital Cities, led by Tom Murphy and Dan Burke, has been expressed several times in previous annual reports. Quite simply, they are tops in both ability and integrity. We will have more to say about this investing in next year's report. And that is it, guys. Thank you for joining me for the 1984 Berkshire Hathaway letter to shareholders. And until next time, Don't forget to like, share, subscribe, and hit that bell icon so that way you know every single time when I post. And until next time, goodbye.